Let's start off here with Land. Land, you're with Allworth's Money Matters.
Oh, hi, Scott and Pat. Thank you for taking my call.
Yeah, thanks for joining us.
So I have a couple of questions regarding the Employee Retirement Income Security Act. And I guess the acronym, how would you pronounce
ERISA?
that? ERI. ERISA. Okay.
ERISA.
ERISA. Okay. So my understanding is that some 401k and 457B plans are qualified at ERISA and some are not.
That's correct.
So is that right?
That is correct.
Okay. So if the plan is protected under ERISA, would you roll them out of the employer plan and into an IRA? And then my other question also is like, do you know if government employee plans have ERISA protection, government plans such as like the state of California and the county of Sacramento?
So you have asked a
It's a good question.
really good question. And we will kind of break down the three different flavors, the differences between IRAs, 401ks, and 457s, right? Let's start with the 457.
The concept is this, right? So the tax law is set up in such a manner that you can say, hey, employer, don't send me all my pay. Take some of my pay and put it in a retirement account for me so it's there when I'm old. And the government encourages this because they don't want to have to take care. There's not enough money to take care of everyone at their old age if there's nothing saved, right? So that's kind of the basic premise behind it. But there's quite a big difference between a 401k and a 457. Because a 401k is the money is taken from your paycheck and it's put into a separate trust for your benefit.
So it sits in a trust. It isn't owned by the employer like a 457 is.
And a 457 is technically a salary deferral where you tell your employer, hey, don't pay me my full paycheck, hold some back, you hold it back, and pay it to me at some future date.
Which is why if you're employed by an organization, normally a state or county, that has both a 401k and a 457, because they are two different plans that sit under two different portions of the tax code, you could put the maximum into both, right? So the 457 is for government employees. It doesn't exist for a private employer, a 457. They do have other tax deferral, salary deferral programs for typically highly compensated people in private industry. So,
and then an IRA essentially where you take your own money, as long as you've got some wages, you can put it into retirement account at gross tax deferred.
So technically the
and it's protected.
Yeah, the 457 is never your money until it's actually paid to you. So if you are putting money in, let's say you work at a water district and you have a 457 and a 401k, and that water district goes bankrupt, technically that 457 is actually an asset of that water district. And the 401k is not.
And you are just one of many creditors.
So if you had a waterfall of things that you would put money into, you'd put it in the 401k first in most circumstances. The difference is, again, there's no 59.5% or 59.5% age for a 457. So you could take the money out
as long as you're retired
or separate from service.
Thank you.
If you quit the water district at age 40, you could actually take that money out and there'd be no 10% penalties. You would pay tax on it.
Or roll into an IRA.
Or roll it into an IRA. So if you had a choice, you'd use the 401, all things considered, you'd use the 401k first until that was maximized, and the 457 second, unless you knew that you were going to separate from service and you would want to get to those dollars for some reason, which is very, very rare. Does that make sense?
Yes, that makes sense. But my question is would you roll them if they are protected under the the ERISA? Would you roll those account out of the employer plan and put it in an IRA?
Okay.
I clearly would roll a 457.
That's
because
right.
I don't like. Well, you're calling from California, right? Calling from California. So
yes, I'm from California.
So now, the odds are California is not going to go bankrupt, but
So the answer is you would absolutely roll the 457 into an IRA.
Particularly if you worked for a smaller municipality, you made it to the water district. I don't care. Maybe it's nobody knows. It's the weird things that can happen in life, right?
Here's the difference between
COVID lockdowns. I mean, you don't know. We don't know what the next weird thing is.
Here's the difference between an IRA and what we will call an ERISA plan, right? So the 401k is under ERISA. An IRA is open to creditors that you could they could put a claim against your IRA, but an ERISA plan is not. So actually,
but there was a Supreme Court ruling several years ago that said if you took money from an ERISA plan and moved it to an IRA, you had up to, I think it was $1 million of protection.
Correct. That's 100% correct. So, you know, when I just watched this is a little off topic, but I just watched the Netflix 4-part series on O.J. Simpson trial. Like, and people were like,
for sharing.
"What?" But they made
Is this a newer thing?
Yeah, brand new. It's fascinating. It's worth a watch.
I remember, Pat, we were in the lobby of our office with the TV monitor watching, waiting for the verdict to come out. The entire staff was out there.
So what?
Our tiny little company.
And
back
this
then.
is where it goes. The reason O.J. Simpson was able to actually spend money and live in retirement in Florida is because
before he was arrested.
So he had a civil. He had a civil charge against him from the Goldmans, and he lost. He lost the civil charge, right? Which means he owed them money, but his money was in a pension plan, which was protected because of the ERISA rules. Had it been in an IRA, they could have gone after it.
That's right.
Right? They could have gone after, and he flaunted that, by the way. I mean, in this documentary, they said he was living relatively large and letting them know, the Goldmans, that they were never going to get any money because it was protected under ERISA rules.
And my guess is as soon as he got his pension checks, he spent it as quick as possible before they had a chance to.
So the difference between a 401k
lovely gentleman.
and an ERISA, a 401k and an IRA is exactly that. An IRA may not have protection against creditors if there is a claim.
So if you plan on murdering somebody,
well,
no, I mean, so for me, like let's say I retired today from Allworth company, and I've got a 401k here, and there's no question I would roll it into an IRA.
There's no question.
And
at
I
all.
have enough umbrella insurance that if I have some strange lawsuit against me or a horrible thing happens, I've got umbrella insurance to protect me.
And I would roll my 457 into an IRA. So, Lan, are you separated from service?
Yes, I am retired, and I have both 401k and 457. But the thing that's confusing me most is that they said not all 401ks are qualified ERISA. For example, like an employee, a government employee plans. And I mean, I worked for the state. I retired from the state, and it's like, it's kind of confusing because the internet can give you a lot of information, and sometimes it just doesn't all ties together.
Your 457 is not an ERISA.
The biggest issue with the 457 is not an outside creditor. It's the employer suddenly having some.
It's an asset of the employer's. That's the difference between a 401k and a 457. It does not sit in its own trust. It is technically owned by the employer and doesn't become yours until they pay it to you. For simplicity's sake, buy yourself $1 million or $2 million umbrella liability, which you should have anyway, or a $10 million depending upon your net worth, or $20 million depending upon your net worth, and roll everything into an IRA. Are you over the age of 59 and a half?
No, I'm 58.
You're 58. Are you spending any money from the 401k or 457?
Not yet.
Do you plan to prior to age 59 and a half?
Probably not.
Then roll it all into an IRA.
Okay.
It just gives you a lot more flexibility.
It's easier to manage. It's all in one place. The difference between some people say, well, do you like Schwab or do you like Fidelity or do you like E-Trade or do you like Altruist or do you like
Chevron, you like BP, or you like Shell?
Yeah, they're all very, very similar, and you could get the same products on each one of them. So the idea that you actually take and consolidate all of these assets in pre-tax IRAs makes it so much easier to manage.
And you can have just as much diversification.
100%.
And greater flexibility in your investment options.
100%. So I wouldn't, if you don't plan on spending any money out of these plans and you're under the age of 59 and a half, roll them in there. Now, if you plan on spending some of this money prior to age 59 and a half, then you may want to leave some money in the 401k as long as you separated from service after age 55. Because if you separate from service in the year in which you turn age 55, there are no penalties from taking distributions from a 401k. The 59 and a half rule only applies to IRAs. It doesn't apply to 401ks as long as you're 55 or older in the year in which you separated. So if this sounds a little bit confusing,
It is.
it is. It is absolutely. So you go on the internet and you're looking all
And
this
now,
stuff.
so the Department of Labor the last number of years have been trying to get more power over IRAs.
They have.
And I think they've been unsuccessful thus far. But for the last decade, they've been trying to regulate IRAs.
So you go on the internet and you're trying to research the difference between the two. The difference is one's an asset of the employer, the other isn't. The difference between an IRA and a 401k is one is open to creditors and the other is not.
Okay.
That's the basics. But I got to tell you, 95+% of the time when we meet with someone who's not going to take money out of a 401k or 457 prior to age 59 and a half, and they've separated from service after age 55, or they're 59 and a half plus, we roll it into an IRA just for simplicity's sake.
Okay. Okay. Thank you.
At the end of the day, people really only need to own about 4 accounts: a Roth IRA, an IRA, a brokerage account, and a cash management account.
And then
Yes.
if you're married, a spouse will have this also. And if you inherited some money, then
That's right.
So you might end up with 10 accounts.
You might end up with 10 accounts, but you want to get it to the fewest number of accounts as possible, just for ease management.
Okay. All right.
All right.
Sounds good.
All right. Thanks, Len.
Thanks, Lan.
All right, thank you.
Pat, there are definitely times when we recommend people not to roll. Here's a prime example. Somebody's 57 years old, planning on working another 5 years. They lose their job. Like, how many times have we seen that, right?
Often.
Very common.
In that situation,
Like, you might want to keep your 401k intact, or at least some portion of it, in the event it takes you longer to get a job than you thought it would.
because after age 55, as long as you've separated from service and prior to age 59 and a half, you could get the money
401k.
without penalties. Yes.
Yeah. So if you've got some uncertainty on your income between those years, or maybe you've retired at 57 and you might choose to pull some money out of that 401k before your age 59 and a half, which you can do.
Yes.
You can also set up what's called a 72T distribution, where essentially at any age, if you're 48 and you've got so much money saved, or you're one of those fire
people.
I don't hear much about that, but what's financial independence, retire early. Live like a pauper, save everything so you can quit working as young as possible.
Sounds miserable.
It does sound quite self-focused, doesn't it? Instead of, how can I contribute to society? Let me take what I can as quick as possible.
And then just lay around the house.
I guess.
Or the van.
But you can set up a series of payments, and as long as it's designed to last you to your dying day, there's some formulas you got to follow. There's no tax penalty on it. So you can set it up. If you're 48, you've got $10 million in your 401k somehow, because you can set up a series of distributions. You probably have to roll it into an IRA in order to make it happen, but
It's an alternative.